Welcome to our webinar series, Secondary Spotlight, that covers the dynamic world of the secondaries market. Here we explore the opportunities and strategic insights in the ever-evolving secondary landscape. Join us for a discussion with thought leaders that share their views and insights on a range of topics stretching from business, operational, to legal considerations.
Welcome to episode 3 of our Secondaries webinar series. Today we have the pleasure to welcome Mr. Ingmar Vallano, a founding partner at Clipway. Dear Ingmar, can you please introduce yourself?
Yes, thank you, Benoit, for the opportunity. So I'm Ingmar Vallano. I'm a founding partner at Clipway, which is a new investment firm that was founded last year. And before that, I started my career almost 20 years ago in private equity and mostly focusing on secondaries, primary, and co-investment. And before Clipway, I was at Arendt.
Thank you, Ingmar. If I'm not mistaken, Clipway is a newcomer to the secondaries market. Can you please tell us when Clipway was founded and a bit more about Clipway and its core activity?
Yes, so the company was founded last year. We are close to 30 people company as of today. We are based with offices in London and New York. And what we do is focus on secondaries, private equity secondaries. Within the secondary space, we are specialized on the LP-led market. So the market about LPs needing liquidity on part of their portfolio and buyers buying portfolios of their interest into funds. And within that space, our preferred type of portfolios of assets are buyout funds mostly, and mature markets, so mostly North American, Western Europe exposure.
Thank you, Ingmar. What is the specificity of Clipway compared to other actors in the secondary market?
Yeah, it's a good question. Why to create a new company? We already have several managers on the market, and especially on a strategy that is, I would say, the traditional part of secondaries, the first to have been implemented on the market. So we did so because we think that there's on this strategy in particular, there's really an opportunity to increase the capacity for buyers to offer a compelling solution to sellers. And that is because on that strategy, the business is very much relying on the data that you acquire on the funds that you want to buy, and processing that data in order to have the best possible projections about those funds, so you can form your investment decisions, your appetite, and your pricing based on that. And for us at Clipway, there was a big gap that the industry needs to fill, and I think it will be done in the coming years, which is the gap between having a business that relies so much on data and not using the opportunity of the new technologies, the new analysis capabilities that are available on the market in order to benefit even more from that data and to be even more competitive. So that was the main purpose of Clipway. And we've developed, we think, processes, organization, and tools that allows us to use the benefit of these new capabilities.
Thank you, Ingmar. This is very interesting to hear. You already gave us an overview of LP-led secondaries. Can you, for our wider audience, tell us more about LP secondaries, what type of transaction it is, and its evolution over the past years until now?
Yeah, so first the transaction itself, if we step back, we have to remind that private equity funds are mostly closed-end funds. That is still, as of today, the main standard structure for private equity funds. It means that you don't have, as an LP, when you invest, you don't have a liquidity mechanism that is offered by the manager or that is embedded in the fund documentation, in the fund mechanism. So you're supposed to stay for 10 years and maybe 10 years plus 1 or 2 years of extension that the manager has discretion to have. And you have that phase of first receiving capital calls so the manager can fund its transactions. And then you're going to receive distribution from those funds when the assets are going to be liquidated. But during this time frame of 10 to 12 years, for many reasons, you might want to exit your position earlier than that and to liquidate your position. And because it's not part of the fund mechanism, you have to find a buyer that is going to replace you as an LP into that fund. So that is what triggered the birth, let's say, of the secondaries market. And this market has evolved a lot. So when I think about when I started in the business, it was still less common for LPs to sell. When LPs were selling, they knew they had to face a price that was not so competitive, that was almost a punitive price. So you had mostly sellers that were, if not distressed, but under some stress that triggered the reason for selling. It can be a regulatory change that makes them having to divest that private equity exposure. It can be a stressed cash situation, but you had long time ago sellers mostly that were using the secondary market as a last recourse. And then the market has expanded and the buyers have become better and better at pricing more reasonably these assets. And that has allowed the pricing to be more in line with what the seller can potentially afford in terms of discount. So sellers now, and it's been the case for many years now, they have a real option because the pricing that they can find on the secondary market is not that punitive. It's a pricing that offers a real alternative. And then it means that it expands the market, and that has explained, I think, the big growth in terms of volume on the secondary market. More and more sellers have the option for many reasons, for any reason why you would want to reshape or rebalance your private equity portfolios, to use the liquidity market to do so. And now we are at a market between 100 billion to 120 billion of volume per year, and we think that's going to continue to grow.
Thank you, Ingmar. Can you maybe tell us why you think that this type of transactions remain relevant in the current market conditions?
So first, because private equity has grown a lot, and given the volume that we're talking about, it's a really established industry. When we think about the volume of dry powder, for instance, that is reported to be on the market as of today, it's the equivalent of deal flow with that current level of volume of secondary transaction. It's the equivalent of 10 years of deal flow already insured by that dry powder that will be deployed by buyout funds and other funds over the next year. So structurally, because the industry is so big, the industry needs liquidity. And it's true for a lot of industries, cars, boats, listed securities, but it's also true for private equity assets. And then from a buyer's perspective, it's still an investment strategy that delivers very specific risk-return profile and cash flow profile to their LPs. And we think that a lot of LPs are still attracted by the capacity to have a secondary allocation within their portfolio, because it brings something, a diversification in terms of exposure to different managers, different vintages, and a different cash flow profile. So also as part of a private equity allocation, the secondary strategy itself play now for a lot of big institutions, for instance, a more structural role. Back in the days, secondary was a good way to boost the ramp up of a new private equity programs, specifically, especially because you could put money at work more rapidly because you were avoiding J curve. Secondary helps mitigating the J curve that you have through your primary activity. But now we see a lot of institutions having a dedicated allocation that they continue to fund on a more structural basis.
Thank you, Ingmar. To conclude, last question. What do you think is the outlook for the future of the secondaries market in the years to come and beyond?
So we see still a lot of room to grow. So for many reasons. Again, the industry itself is big enough and is going to be, I think, to sustain its growth over the coming years. So the secondary market is going to follow that. But also, if you look at the volumes that we're talking about in terms of how much of the existing NAV is traded each year, despite the growth of the secondary market, we're still talking about from 1 to more or less 3% maximum of the current NAV that is traded each year. It doesn't mean that, as it's the case for some industries that the secondary market is going to become much bigger than the primary market. It won't be the case, but I think there's still room to grow. And when you think about the factors that were limiting that growth in the past, it was in part perception of the sellers that maybe it was a bad thing to show that you were selling on the market. I think this has completely changed. Now it's a sign of sophistication. You have the capacity to manage your portfolio in a more sophisticated way if you use, among other tools, the secondary market. The managers themselves, they didn't like when they had LPs that were selling because they saw that as a sign of maybe distrust from these LPs. Now they understand that LPs sell for many reasons. And actually, if you're a manager that facilitates the transfer, all of that is helping the big allocators into private equity to feel more comfortable, to come back in the new fund with bigger tickets because they know that they will still have the option to use the secondary market if needed at some point to transfer their assets. So these structural needs are going to continue. And on top of that, I think to come back to the first point, I think the buyers can still become more and more efficient into providing liquidity solution because today there's still a big gap between the data that these buyers are exposed to through their secondary business, through their primary business, and how much of this data is actually used in order to form deep analysis and deep investment conviction and to offer a good price. And in spite of that, we've had a big growth, but I think that now that these tools are going to be more used by the buyers, they're going to become more efficient. And historically, when they become more efficient, the sellers are more satisfied. It opens up the deal flow again to many more sellers that can afford, with limited impact on their performance, to use the secondary market. And that will fuel, I think, the growth. If we think about the evolution of the market of the past years, some people sometimes are focusing at a given point in time and wondering if the market is more a seller's market at some point or more a buyer's market. I think that what counts is the general trend. So far, the general trend is a very nice balance between the returns and the type of cash flow profile that the buyers are offering to their own LPs, which tend to be quite satisfied with their secondary allocation, and still the satisfaction of the sellers who, for many different reasons, can access the secondary market. So I think that balance is going to continue as long as the market continues to expand in volume. And I think the use of data and data analytics in particular for the LP-led market is going to be one of the drivers to go in that direction.
Thank you, Ingmar, for these very valuable insights. I would like to thank our participants for joining today. I hope that you will have enjoyed this very instructive session on the LP-led secondaries market. Dear Ingmar, thank you very much.
Thank you, Benoit.
Thank you for listening. We hope you found it interesting. If you would like more information about secondaries, we invite you to visit our website, www.arendt.com. If you don't want to miss our latest episodes, please feel free to subscribe to our newsletter to receive our invitations.